Thank you for joining us for today's webinar on Startup Accounting Essentials. I'll be your host for today. My name is Jerisa Blunt, and I am part of the marketing team at Early Growth, and we are so excited for you to join us today. If you're not familiar with Early Growth, our founder and CEO, David Ehrenberg, founded Early Growth because he saw a true need for a company like Early Growth for early stage startups and companies. We've been around in the ecosystem for over 10 years, and there was a need for expert CFO, accounting, and tax services, and that was started over 10 years ago by David Ehrenberg. So today we have two presenters, two of our CFOs. We have Ala and Sirk, and they will be talking to you today about startup accounting essentials. So they're going to take you through several steps, and at the end we'll have time for Q&A. Anyone who registered for today, please know that this presentation will be available in the next 24 hours. We'll send you a link after this presentation. You can also find this presentation on YouTube at Early Growth. If you have any questions that are not answered during the Q&A session, feel free to send us an email. That information will be at the end. And we'll get started with pre-funding.
Okay, well, before we get started, a little bit about Sirk and myself, a little intro. I've been with Early Growth for about 10 years. I've had the fortune of really working with a lot of exciting startup companies that have now gone up to either be big public companies or have continued to grow and be acquired or have really good exit events. So the area that I work in is primarily in SaaS, but I do a lot of e-commerce, a lot of technology, hardware and software, and service companies. My background is essentially in accounting. I worked for Arthur Andersen early on in my career and kind of progressive experience until I landed here at Early Growth. Sirk, maybe a little bit about yourself before we get started.
Thanks. Yeah, thanks, Ala. My name is Sirk Rowe, and I am a consulting CFO with Early Growth as well. I've been with the firm for 6 years, so not nearly as long as Ala, but I've been with the firm for quite a while. And like Ala, I have extensive experience working with startup companies in different industries, software, hardware, consumer products, a lot of technology companies, as you can imagine, being here in the Bay Area. I also work in the nonprofit sector as well. And we are or all three of us are very, very excited to have you join us today for this presentation.
Great, thank you, Sirk. So what I'm going to be covering right now is some basics of startup accounting. We call it here pre-funding, but let me kind of clarify. Really, it's the funding is really not the event. It's really with the size of your company. Some companies are bootstrapped and have fairly significant operations that this so-called pre-funding items that we'll go over really will not apply to. But we call this section pre-funding really as another name for a company in the very early stages. Perhaps there hasn't been like any significant capital put into the company. There isn't any significant activity. It's in the early formative periods where, pieces are being put together. Initially, when we were doing at Early Growth, when we would talk to a prospective client, we typically used a $500,000 in the bank kind of benchmark to figure out whether that's pre-funding or not. But essentially, really a company that is just getting started, that has some activity, but not an extensive amount of activity. So this section really covers what to do in that phase. Next slide, please. So let's oops.
Sorry about that. It's so
No
sensitive.
problem. No worries. Thank you very much. First, let's start with the basic, the bank account. The one advice I would give to entrepreneurs or startups is in the early stage is really to segregate your personal business from the company. You've probably already gone in and you've created a corporate entity and you've gotten all that paperwork in place. So continue on to that process by opening up a business bank account, something for the company by itself. If you're not able to do that for whatever reason, clearly separate the business expenses from your personal expenses somehow. And we'll cover another way of doing it without doing a formal bank account. But the easiest way is really to create a bank account just for the company. And if possible, try to segregate the payment methodologies, you know, a corporate credit card, a payment card, or something that is different from your day-to-day expenses, from your personal expenses, your rent, your insurance, and so on. And finally, then create what this does is it creates an audit trail. And at some point in the future, when you're ready to have formal record keeping process, if you have a separate bank account and separate payment stream, all that information can be easily downloaded into some kind of accounting system. And you could then recreate your financials from that inception. It's very, very difficult if say you're a year in formation and you're using your personal bank account and there are certain transactions in that personal bank account that relate to your business for an accountant later on to go in and select what those items are. So opening up a bank account that's dedicated to your business is a key bit of advice that we would give.
Let me just add one other point on this as well, because we get this question a lot, is in addition to obviously the accounting and tax purposes, which obviously benefit people like us who come in and assist companies, but there's a pretty big legal reason as well. And that has to do with kind of separating the company liability from your own individual personal liability. To the extent that you are setting up some sort of a corporation which limits the liability of the company, then you're kind of doing yourself a disservice by kind of commingling transactions between personal and business transactions, such that someone might be able to come in and make an argument or try to claim if something goes wrong in the future, that not only is the corporation liable for any potential liability, that because of the fact that you didn't segregate your transactions from personal to business, that you personally may be liable as well. And so, that's just a second and very important reason why you want to make sure you try to segregate the transactions.
Excellent point, sir. Next slide, please. So the record keeping process. So you've already hopefully created a bank account and a separate payment portal for your company. So some of the other kind of items to keep track of in this what we call the pre-funding phase is really make sure that you're keeping good records. So if you have payments that are due to you, please collect them. There's a tendency early on for companies that are in what they perceive the pre-revenue phase. If you have, say, a trial or some kind of event that the company would collect money, even though you're not formally in the revenue process, to kind of put those aside. So make sure that you collect any kind of payments that are owed to you. When we say select an HR provider, what I specifically mean is if you have payroll, have somebody else do your payroll. Don't do the payroll yourself. Because really the consequences there are pretty expensive. Payroll services right now are a dime a dozen. There's literally, hundreds of them out there. And they're relatively low cost. And when you select the payroll provider, make sure that they're also responsible for doing your payroll taxes. Take it from our experience. There's been instances where somebody's doing their own payroll. They're a few days late in either depositing the remitted payroll taxes or filing the payroll taxes to the state or the IRS. And the penalties for doing that are fairly significant, sometimes even more than the taxes that are owed. So, just do yourself a favor. If you have payroll, select a payroll provider and have them do your payroll and payroll taxes. The next point is stock records. In the early stages of a lot of companies, the typical company here in the Valley, for example, because there is lack of cash, a lot of times you'll have consultants or folks doing work for you, not for money, but for stock. There's a tendency for entrepreneurs to lose track of that. You'll hire a engineer to do a certain phase of your product development, and you'll say, we'll give you 50% of your compensation in cash and 50% in stock. And that then never really gets documented. And, a year later, when you're in a valuation round, that person will come back and either come and say, you promise X amount where you really promise Y. And then, the terms of the stock grant that you had verbally are not clearly identified. And that's really the wrong time to negotiate it. So stay on top of your stock records. If you've gone ahead and formed the corporation, you probably have had some help in form of legal help. So make sure that your stock records are in order as you proceed with the company. Next slide. Yeah. Expenses. So one other casualty of today's online world is that most of the transactions are done online. So you'll go on to Amazon, you'll buy a bunch of office equipment, you'll submit your credit card, and it gets delivered. And all of a sudden you kind of lose track of that whole transaction. I had a client just very recently did a series of transactions very early in their formation, where they were importing parts from that had to go through customs, and they purchased everything through credit card. This is now 2 years later. The state taxing authority came back to them asking for sales and use tax. They essentially had no record of that transaction. They didn't know whether they paid the sales and use tax or what these items are for, just because it got lost in the noise. And they ended up paying a fairly hefty sales and use tax bill, plus interest, plus penalty. So keeping records and receipts of your business transactions is really, really important. And a kind of a good guideline of what to keep and what not to keep are any items over $75. You should keep related support documents. So even if in my Amazon example, create a Dropbox. If you don't have a formal accounting system, and just download all those receipts and items in there. If you could organize it, great. If not, at least there's some place that you could go back and look at. Next slide, please. The next kind of relates to the previous point of keeping on top of your stock transactions. Getting a cap table in place is very, very important. Just kind of to recap, a cap table is simply a listing of who and the pricing and terms and the number of shares that are held by either individuals or entities in your company. It's essentially a list of who has equity in your company. In the early stages, it's very, very simple, and it could be done on an Excel spreadsheet, and most likely your lawyer who formed your company might help you with that. but keeping that updated as you go along, as you issue grants to consultants, or as you add, say, convertible notes into there, just making sure that your cap table is in good order in this very early stage is very important, because that cap table, as you'll grow and get some subsequent funding from outside sources, will be a lot more complicated, and will be a really, really critical document. So make sure that that cap table is in good order as you go along, and don't neglect it in the hustle and bustle of trying to create a corporation. Next is compliance. You know, what do you need to worry about from a compliance point of view? Obviously, taxes. So keep on top of all the tax deadlines that you have. The tax penalties associated with not filing or filing late are fairly significant, and there's really no reason for you to put yourself in that place, especially early on. A lot of companies probably will not have a federal tax obligation. So there's a tendency to kind of say, well, I don't know anything, I don't have to file right away. That's actually not the case. Even if you have a fairly significant loss status, you still have to file. And a lot of the states have minimum fees, whether they're franchise tax fees, like here in California, or some other kind of fees, be on top of your income tax filing requirements in the states that you're currently doing business in. So making sure that you're in touch with your tax professional, or if you have a tax savvy yourself, making sure that you understand all the different deadlines and requirements is really important. Second is the business licenses. You know, a lot of states or cities, excuse me, have license requirements. I know we have one here in San Francisco, and there's one in New York, and so be cognizant of the business licensing requirements. On top of that, there's also property tax obligations in a lot of counties and cities as well. So those tend to kind of go by the wayside, and the penalties for those would be steep as well. So make sure that wherever you're located, that you're on top of your business license. I'm not sure what C Corp filings essentially means, but that's probably things like the state of Delaware, for example. There's separate filing requirements if you're a Delaware incorporated company. So you know, make sure that whatever franchise or state filings that you have on top of your income tax filings, that you stay on top of. You know, Delaware is an example that we use because there's a lot of Delaware incorporated companies that don't have an actual operation in Delaware, but they still have to file an annual Delaware tax return that goes along with their business. So very, very important to stay on top of your compliance obligations. So now we've kind of gone through, you know, what to do in stages early in most companies, what we call pre-funding. But now the business is getting a little bit of traction, and you're now ready to either get some outside funding, or the company is kind of getting to the next level of operations. So there's some additional things that you have to worry about.
Hey,
so
Ala, can I just interrupt for just a second?
Sure.
I just wanted to add one point, you know, before we get into the fundraising prep, which is that, you know, Ala has kind of, you know, highlighted, you know, some things that we should be doing initially early on in the game. We haven't touched upon yet, you know, like some tools, right, that you might be able to use. We are lucky, fortunate to live in a time when there are tons of tools available both from a professional services standpoint, but maybe more so from a cost-effective standpoint, online tools, right? So, for accounting systems, if you have the wherewithal to do so, we highly recommend that you start using an accounting system earlier rather than later. That'll make record keeping as well as reporting much simpler. So, the likes of QuickBooks Online is used by, the vast majority of companies in early stages. We highly recommend that. There are other, tools like Xero and others as well, for equity tracking, cap table tracking. There's CapShare, there's Carta, other online tools such as that. Alda touched upon using a payroll service provider to do our payroll. So the likes of, Gusto, and there's tons of other online sources that you can use. So we encourage you to look at your different options, and, to the extent that, you feel comfortable using some of these tools, the earlier you can get started on these, the better off you are. Just because it just takes a lot more effort to try to catch up on some of these things rather than doing things correctly in a systematic order earlier rather than later.
Absolutely. Good. Thanks for bringing that up. That's excellent. Another one too that we use a lot is Bill.com. To the extent that you have a bank account that's segregated to your company, it's an excellent tool to help track and manage your payable process, and essentially create an accounts payable structure in the cloud for you. And it actually will make you look a lot more professional in the light of your vendors as well, because it's an easy tool to use, and really will help you kind of keep track of your payable system. Good point, sir. Thank you.
Sure.
So getting ready for fundraising. So the obvious thing that will happen when you're in the fundraising process is that you have to go pitch. So you have to talk to folks about your company and what you're trying to do, and how much money that you're looking for. So in the fundraising process, you really are focused on two things: an executive summary, and really the executive summary is a one-pager or even less than that you could send to a prospective investor or somebody who just wants to know a little bit more about your company, in a one page. So getting that executive summary ready is really the first stage, and will really help you in formulating also the pitch deck and your elevator pitch later on. A lot of times when we're go back one slide now. Yeah. A lot of times when somebody is asking for, say, an introduction to a fundraising source or a potential investor, what I ask for is, I actually don't ask for the pitch deck right away or even ask for the elevator. I ask for the executive summary, so I could kind of get an understanding of it. And I would typically send elements of that executive summary to a prospective investor to let them know a little bit about the company. So having an executive summary in place is a really important tool. We obviously, the pitch deck, that's really the bread and butter of your whole fundraising prep process. Formulating that pitch deck, making sure that it's clean, concise, and to the point. It sounds like a simple process, but it'll probably be the most time-consuming, and should be the most time-consuming and activity that you should take very, very seriously, because that pitch deck is going to convey a lot, and you need to get a lot of information into a few slides, like we will show in the next slide. But focusing on that pitch deck and making sure that it's clean, concise, and professional is really, really important. The elevator pitch is exactly what it sounds like. What will you say to somebody that you meet in an event? Tell me something about your company. You're not going to sit there and open up your notebook and show them your pitch deck. but you're going to have something a little bit more expansive than the executive summary and something a little bit more concise. So working on your elevator pitch, telling people what you to do, will not only help formulating your pitch deck, but will make you look really, it will be needed a lot in the fundraising process. Next slide, please. So here's just kind of a crude example of pitch deck, and we actually have a webinar that we go into a lot of detail on this, so we're not going to do that here. But typically the elements of the pitch deck is, as you see, your mission and vision is really the kind of the opening to your pitch. What are you planning to do, and what kind of got you here to form this company. The problem solution is, why did we form this company? Typically there's a problem out there that you're trying to resolve, and you feel like you have a solution. Another critical slide into your pitch deck. Addressing the market opportunity. That's going to be really critical to talking to investors that may not understand your space. But being really concise, we go through this in a lot of detail, but being really concise in this market opportunity slide and showing a prospective investor, where the possibilities in the market could be for your enterprise, really key. Of course, your strategy, how are you going to go to market? Your go-to-market strategy, your selling strategy, and your product development strategy. That's going to be a really important slide, and something that has to be done in 1 or 2 slides as well. So a very, very critical element. Talking about your secret sauce, your technology, or your product or your service, how you differentiate yourself from the competition out there. That's a critical slide. Competition, there's no such thing as a business without competition, so make sure you address it. Of course, the financials are a really important part as well. But when we talk about financials here, you're not talking about a full-on model. It's usually a 2 or 3 slides at the very most. So it has to be very clear, concise, not too many charts, not too many numbers, just kind of the right mix. And I always counsel folks working on their pitch deck to consult with a finance professional to make sure that you're getting the right message across. In your pitch deck, in your pitch, you're not going to have time to go through a full-on model. So the financial information is going to have to be clear, concise, and summarized. Finally, understanding what you're asking for. The old adage, if you don't ASK, you don't GET. It's important that you lay out in your pitch deck what you're asking for. We go through again, how do you determine what to raise? But in a nutshell, what we say is make sure that you raise enough money to meet the next milestone of your business goal. But that is a critical slide, of laying out what you're asking for and what you're going to use those funds for. And typically that what goes along with that funding is a milestone, because again, we recommend to our clients that if throughout your enterprise you think you need $100 million, you don't ask for the 100 million all at once. You ask it in tranches based on milestones. And laying out those milestones to a prospective investors helps them understand what your goals are. And that's a fairly important slide. Again, the final slide here is probably one of the most important slides as well, is your team. I don't know how many times I've presented investment opportunities to potential investors where the first question they ask me is, how does the team look? They don't ask really about the product, about how much they need, but they talk about the team. And that's tells you a little bit of how investors view enterprises. They really, really focus in on the team, and to the extent that that is a differentiator, make sure you highlight it. And either way, it's a critical part of your pitch deck. So make sure that you have the right folks in here. And by the way, the team is not necessarily the folks that are maybe getting paid or on your payroll. It could be also advisors, you know, outside consultants. They're also part of your team. So, Sirk, anything in this that I left out?
No, that was outstanding. All I have nothing to add.
Okay. Next. So the funding financials. I'll just briefly go over some really two approaches on the funding financials, and then Sirk will kind of take it over from there. But on the next slide, if you're very early in your stage, you're going to have to do some kind of projection. Obviously, if you have history, you'll present that as well, meaning your actual financials, but most of the time you'll be doing financial forecasts and projections. There are really two types. There's top-down and bottom-up. And typically the guidance I give to most of my clients is that your financial slides in your pitch deck should be a combination of top-down and bottom-up. I like to present no more than 3 years. I just think that going over 3 years in any kind of financial projection for a startup is really not meaningful. But so in the first year of your projection, I like to use bottom-up forecast, and for the following years, I use a top-down methodology. Simply, the top-down is really taking kind of a more global or high-level approach to your forecasting. So in this example, you might start with the total market size that you're addressing. And then you could, in a revenue top-down projection. And then from there, you could say, you know, I'm addressing this particular segment of my market, you know. And from there, I could say, based on that addressable market, I project to take X% of that market and calculate your revenue forecast that way. Another top-down financial projection from an expense side could be on a head count. You could say, okay, I need salespeople to cover, you know, my $10 million revenue forecast. I project that each salesperson is going to have a target of 1.5 million annually. So therefore I need, you know, I don't know, 8 or 7 sales hires in the first year. So that's the kind of approach that you would take in a top-down financial projection. Some of your operating expenses could be tied to your revenue, you know, X% of your revenue, so you don't have to really drill down to detail, which is really what the next slide is all about. And that's really a bottom-up financial projection. Next slide, please. So in a bottom-up projection from a revenue point of view, the difference could be where you drill it down to specific markets. If you're addressing, say, a certain enterprise, you could separate your revenue into, you know, either a pipeline. You could say, here's my current pipeline, and therefore my revenue for the next year is this based on that pipeline. It could be based on the number of salespeople that you have either hired or planning to hire, and you're drilling down and saying, okay, here is the quota for each salesperson. But in that first bottom up is a very, very detailed revenue forecast. It's not a situation where you're saying, my market size is X, I'm gonna address a percentage of this, and I expect to receive a smaller percentage of that addressable market. This is a lot more detailed, something that you could present to an investor that has some meat on it. So, you know, a revenue forecast that is either pipeline based or based on, you know, your current sales force or your go-to-market strategy, either from a marketing platform for, say, a SaaS, e-commerce type company, something that's supported in that way for your revenue forecast. On the spending side, you're going to get a lot deeper. So the biggest operating expense is your headcount. So typically that is supported by specific hiring plans, and that you break that down by your enterprise. I'm going to hire these engineers. This is my expected salary, and here's what I'm going to hire them. I'm going to hire these sales and marketing folks, and here's when I expect to hire them. Then you go deeper into projects. So if you're doing a lot of marketing, you could clearly identify all the different marketing programs, your advertising, your conferences, whatever you're going to do in the market. But the bottom-up forecast is that level of detail, is going through your enterprise and getting the input from all the different folks in your company, and having them really essentially form a budget. And that's why I like to do the bottom-up forecast for just 1 year, because once you go beyond that, it's very, very difficult to estimate, your hires 3 years from now. So that is essentially the process that you will go in formulating your financials for your pitch deck. Next slide, please.
Thanks, Ala. I'll take over for the next part of the presentation. However, I did want to add a couple of points about the projections of financial plans. So first, a quick plug for some of our other webinars that we've done. We just Ala really just touched upon a very, very high level discussion about how we put together a financial plan that goes into any kind of presentation or investor deck. We have done many presentations in the past that really drill into the kind of some of the nitty gritty associated with putting together a financial plan or a budget. That's not only useful for operations, but for fundraising as well. So we encourage you, as Jerisa mentioned on the top, to check out both our website and or our YouTube page, and you should be able to find past presentations. And I'm sure we'll be having more in the future that dive into much more detail. And then secondly, what was one other point I wanted to make? And then secondly, it's putting together a financial plan, especially for investor decks, investor pitch decks, is a bit tricky from the standpoint of you kind of have to walk a really fine line, because on the one hand, you are saying that you need investment, right, from outside. But on the other hand, you're also saying that you're going to be successful financially in the future. And so kind of marrying those two together such that you tell the right story in your financials that, that makes a compelling case for an investment today, as well as the milestones that you're going to hit with this investment that's going to allow us to raise additional money at much higher valuations in the future. That's really one of the critical things about putting together a financial plan. And so to that end, I'll kind of echo Ala's point, and obviously, say something about the work that Ala and I do, which is that, you really, unless you're experienced in this, unless you've gone through fundraising processes in the past, that having a financial person who is experienced in putting together financial plans for pitch decks and for investor presentations is really going to help you to not only put together a financial plan, but also make you look good in front of potential investors, which obviously is something that we want to do. So those are the two things that I wanted to add on that. So let's go ahead and talk about what we want our financials and our accounting to look like post-funding. And I'll even touch upon maybe even, we say post-funding, and now we're probably talking about, after we raise a round of financing, whether it's a seed or a Series A, or maybe we're just even not necessarily post-funding, but we've kind of, grown internally, operationally, and we've been successful, and we've grown our company to a bit of a larger state, and we probably need a little bit more in terms of financial reporting and record keeping. So let's talk about that. Okay, so first, and I know your eyes are going to glaze over when you see stuff like this, but we do kind of want to touch upon generally accepted accounting principles, or GAAP. And it's really important because what GAAP does is it kind of gives a reporting standard that not only that basically you follows the same rules, right, for every company. And it's important because this way people are able to compare how we're doing as a company versus someone else, as opposed to if you use some other type of non-accepted accounting principles, then there are different ways that we can kind of game the system to make the numbers look better than they might be, or definitely different compared to others. And so because of that reason, then investors are going to want to know that we are presenting financials on a GAAP basis. And the main parts of GAAP there's lots of parts of GAAP, but the main parts of GAAP that we are interested in as a startup company that is doing reporting is really this idea of accrual versus cash accounting. So cash accounting is very, very simple, right? You just look at cash flow, what's happening with cash, and so revenue is recognized when cash is received. And as we know, in some cases that may be the one and the same. If we're selling something at a store, for example, and someone pays cash for it, then obviously the timing of cash versus revenue is the same. But for other companies where, for example, we may be invoicing, right, for our services or our product, and we don't receive cash until later on. If we are invoicing, like for example, for SaaS companies or software as a service company, and we invoice or we collect 12 months of service revenue on day one, but then we don't, but we're obviously offering a service over an extended period of time. The timing of the cash versus when we're actually recognizing that revenue is the difference between accrual versus cash accounting. As you can imagine, if you looked at just cash accounting, you could think of ways that you could game the system, right? You can game the numbers to make it either look more favorable to you, for reporting purposes, investor reporting purposes, or differently for banks. And some companies have gotten in trouble for that. And what we want to do is we want to try to use accrual accounting, and we want to try to do it as early as possible. And the second, obviously, on the expense side, so the same exact thing, right? The difference between accrual accounting versus cash accounting is the timing of when we are recognizing that expense. In cash accounting, again, you recognize the expense when the cash is spent. In accrual accounting, you actually recognize expenses as they are incurred in the month or in the period that the expense was incurred, rather than when you actually paid it out. And again, there could be differences in timing. In many cases, as companies get larger, there will be differences in timing between when expenses are incurred versus when it's paid out. And again, for purposes of GAAP accounting, we want to be using accrual accounting. And then there's other kinds of financial reporting that we'll talk about, but that's kind of the first and foremost is earlier rather than later, as early as you feel it makes sense for you, moving from cash accounting to GAAP accounting or accrual accounting is going to help you from not only from a record keeping standpoint, but from a financial reporting standpoint and from a fundraising standpoint as well, because that's the way that investors want to see financials. And the longer that you wait, the more effort it's going to take to switch from cash accounting to accrual accounting. Okay, next slide. As part of setting up your accounting, you will be preparing a chart of accounts, and so these are basically all of the accounts that make up your accounting system, and that includes balance sheet accounts such as cash, accounts receivable, prepaids, equipment. It also includes expense categories, as you can imagine. So payroll, office supplies, consulting, things of that nature will be included, as well as revenue and equity. So all four types of accounts you will be setting up. What I recommend early on is just keep it simple, right? Luckily with most accounting systems such as QuickBooks or Xero or NetSuite or what have you, it's very, very simple to add on accounts as needed. So there's no reason why you need to be thinking about, oh my gosh, what's my business going to look like 2 or 3 years from now? And let's set up a chart of accounts that accounts for that. Rather, just kind of keep it simple and add on as needed. And when people say, well, when is it needed to add on? It's when we need to see the additional visibility that more accounts will give us, right? So that's going to be different for every company, every type of industry. Luckily, there are in most accounting systems, there are templates that you can use. You can find online or within the accounting systems themselves. If you're a SaaS company, there's kind of a typical chart of accounts that you might start with. If you're a consumer products company, similarly, if you're a retail company, there will be different chart of account templates that you can start with. And so finding a template should be pretty straightforward. And then I would just kind of go with that and then and just kind of add on as needed in the future. Okay, and then there's really three, from a reporting standpoint, there's really three financial statements that you are going to want to look at, that investors are going to want to see on a regular basis, whether that's monthly or quarterly. Banks, if you have any kind of relationship with a bank, beyond just having an account open with them, but if for example, if you've taken on some debt, if they've given you a loan, banks are going to want to see these statements on a regular basis as well. And that is the income statement, the balance sheet, and the statement of cash flows or cash flow statement. So the income statement is, you can see a very, very high level income statement here, and it really looks at what's happening to our business over a period of time, right? So this looks at, the very, very high level shows how much revenue is coming in, what that revenue is made up of, different line items, and what expenses are going out, right? And then the net of that is obviously either a net income or a net loss. And this kind of shows, how the company did over that period of time. Whether it's for a month, whether it's for a year, whether it's for a quarter, whether it's for multiple periods, and you'll probably want to track those kind of on a timeline basis so you can see how the company is doing over time. But the income statement, shows the progress of the company over a period of time. The balance sheet is a second and very, very critical a financial statement that you need to be keeping track of. And this basically, it shows a snapshot of three things: the assets of the company, the liabilities of the company, and then the equity that the shareholders own of the company. And it's at a point in time, unlike an income statement, which shows kind of the progress over a period of time. This is a snapshot. So as of, in this case, December 31st, 2012, we had this many, we had $89,500 worth of assets, and it was made up in these different categories. We had liabilities of $17,500, made up of accounts payable and loans payable in this case. And then we had stockholder equity of $72,000. And as you can see, we call it the balance sheet for two reasons. One, it does keep track of all three of these things, but they have to balance, right? The assets have to equal liabilities plus shareholders' equity, which is what this shows here. And the way that it works is definitely some accounting, but it marries what's happening on the income statement. It brings in any net income or net loss from the income statement into the equity section, and between the liabilities and shareholder equity, it ends up equating out to the assets of the company at any point in time. This is not something that you're going to want to try to track on a spreadsheet. It's going to be much more difficult. Again, we highly encourage you to use something like QuickBooks or Xero or NetSuite or something like that. One of the real big benefits of using a software like that is it actually will keep you from being able to get these balance sheets out of line. Like you physically cannot make entries into QuickBooks you know, where if you run this balance sheet statement, that the total assets does not equal liabilities plus shareholders' equity. Whereas obviously, if you're kind of trying to do stuff and track stuff on a spreadsheet, you run into, you know, these kinds of potential issues. Using, you know, QuickBooks Online or something like that makes it impossible for you to get out of balance. So this is really, really important. And obviously, you know, this gives you visibility into what you own and what you owe, right? And we obviously always want to be aware of those things, as well as investors are going to want to be aware of those as well on a regular basis. And then the actually one below that, one before that, Teresa, the statement of cash flows. There we go. Oh, okay. I guess that's a little bit touchy. And then the statement of cash flow. So, you know, this is a statement that shows kind of what's happening. It really, what it does is it kind of marries the income statement. It combines the income statement together with a balance sheet to show what happened to cash. And obviously for us as entrepreneurs, especially in early stages, cash flow is king. We know that. That's obviously our lifeblood. Without cash, we basically die, right? Everything else we can fix. If we have cash, we have time, and with time, we can make adjustments as needed. We can, you know, improve our performance. We're obviously, you know, able to make changes to improve our situation. Once we run out of cash, we're basically done. So the statement of cash flows, what this does is it basically says, okay, I know what happened with our income statement, but as we just stated in the first slide here, GAAP accounting says that, you know, we are trying to account for revenue, you know, when it was earned rather than when we receive cash. We are accounting for expenses in a time period that it was that we spent the money rather than when the cash again left. And so because of that, the income statement doesn't tell us exactly what happened with cash. Rather, what happens is that there are changes in the balance sheet accounts that that also impact what happens with cash. And so that's what the statement of cash flows does. It basically takes into account all of the net income, but then also some of the changes in the balance sheet accounts that happened over that period of time that impacted cash to get us to how much cash do we really spend over a certain period of time. So in this case, you could see that we actually, it looks like we decreased cash over this time period by 20,000. And we started with cash with 39,000 and ending with 19,000. But again, this is a statement that is a little bit arcane. It's a little bit, if you're not an accountant, it's a little bit hard to follow. You know, we highly encourage you to, you know, again, using the likes of QuickBooks, this will become kind of a standard financial statement that you're able to generate. And to understand really what's happening with cash. In fact, this is usually one of the first things that I go over with my clients is the statement of cash flows and all the things that happened, you know, that made our cash balance different from what happened to our income statement. Okay, and then finally, and staying on cash because it's so important is as an entrepreneur, you know, I kind of already mentioned again that, you know, that cash is king. You know, whether it's for yourself, whether it's for a bank, whether it's for investors, you know, the two numbers that you have to have at the tip of your tongue and the front of your mind at all times is how much cash do we have and what's our runway. Right? And when we say, obviously, how much cash do we have, we know what that is. Our runway is how much time do we have with the cash that we have on hand, right? So if we're a small software, if we're a small consulting business and we are generating more income than our expenses, and we have positive cash flow, obviously this isn't this is less critical. But for most of our clients, especially in the tech space that are going after, you know, investors, outside investors, we are burning cash, right? We're spending more cash than we're bringing in. We may be early stage, we may still be in product development mode, or we may be in revenue generating mode, but we're still investing a lot of money into our business, right? And so we're actually burning cash more than we are bringing in cash. And so understanding how much cash we have on hand, understanding how much we are burning on a monthly basis or quarterly basis, and understanding how much time we have with the cash that we have remaining, assuming certain assumptions about our expense structure, our hiring, our revenue generation. Having that number at the tip of your, in the forefront of your mind is really, really critical, both from an operational standpoint, as well as communications with our investors, as well as obviously pre-planning for any kind of fundraising that we're going to want to do, right? Fundraising takes a fair amount of time. You can't get to the point where you only have 3 or 4 months worth of cash before you actually start that process. So knowing when we run out of cash and working back from that, as we kind of go through some of these efforts with regards to fundraising, or decreasing our expenses, or somehow finding a way of increasing our revenues, is critical. And so one of the things that we put together is a very, very simple chart like this, right, which says this is kind of what our cash burn has been and what we expect our cash burn to be going forward. And all of that is being generated from not only the actual financial statements that I've highlighted in the past 3 or 4 slides, but then also the financial plan that Ala mentioned as part of the fundraising effort of putting together a financial plan. So, not only looking back, but also, what we expect to see going forward from our financial plan or any budgeting effort that we put together is what should drive this chart. And for us to be absolutely on a monthly basis, we should be looking at this after we do the financials, after we get those actuals in. We should be comparing this against what we had budgeted, make sure that we can understand any discrepancies or deltas between the two, kind of project that out going forward, and always know, based upon the most recent data sets, how much cash we have and how much runway we have left with the cash.
Awesome. Well, that concludes our presentation for today. Do we have any time for a question?
Well, I see a couple of questions. I think Mayan asked, is there a list of all these tools that we can be provided? Well, probably hard to kind of go through all of them. I think I've mentioned some of them. You will get a presentation of this. So, like I said, for accounting software, I think the de facto standard for most startups is QuickBooks Online. There are others. I mentioned Xero. That's Xero with an X. There's NetSuite on the higher end side, as well as ERPs. We highly recommend at an early stage, unless you're really, really know that you want to use one of the other ones, then we highly recommend QuickBooks Online. It's simple, it's cheap, and the best thing about it is that it's ubiquitous. It's known by everyone. You will be able to find tons of resources, accountants, CFOs who use it. Being able to find resources to assist you with it is easier than other systems, and so we highly recommend that. From an equity standpoint, CapShare, Carta are 2 that I've used and feel very, very good about. Again, these are software as a service types of companies. We encourage you to look online and see if they make sense for you. Ala mentioned Bill.com for payables as well as even receivables. You can use Bill.com to send out invoices as well, but that's a good one. For expense management, there's the likes of, Expensify is what we use. There's just lots of tools out there. For payroll, Gusto is one that we use, but as Ala mentioned, there's probably hundreds out there that offer similar services. Ala, do you have any additions to that we would want to highlight?
No, I think you've pretty much addressed it all. Just if you're kind of going through a process and you're doing something on a manual, in a manual way. There's a lot of research that you can do online, and all the tools will be out there. Or, you know, if you have a finance consultant or an accounting consultant like ourselves, or there's a lot of them out there, bookkeepers, they could give you a lot of input there.
Yeah.
I see some questions out there. I think Sasha indicated that how long do you keep receipts? You know, this is primarily for tax purposes. So, you know, the caveat of consult with your tax advisor, but yeah, 7 years is the rule of thumb. There are some items that you have to keep forever, essentially, for a very long time. Things like payroll records and tax returns and so on that you have to keep. So, but I would really the guidance there is to consult with your tax advisor on that one. And then another question from Alex related to being an independent contractor. Do you deposit it into your LLC bank account? If you're an independent contractor, most likely whoever you're doing the services for will ask you for a W-9 form. In essence, that W-9 form will gauge your tax exposure. So if you fill out the W-9 in the name of your LLC, the 1099 at the end of the year will come to your LLC, and you will not be taxed twice. If you fill out the 1099 as an individual, that will then come to you as an individual, and the 1099 will go directly into your individual. So that will be the tax exposure. But then again, please consult with your tax advisor on what the best way to go here. I think we have 2 more questions.
Yeah. So there were 2 more questions. One is regarding how do I do my taxes for my Delaware C Corp if we haven't launched our product and do not have any revenue? You still need to do your annual filing with Delaware C Corp. It actually asks questions about not just revenue, but it asks questions about your cap table, how much stock is outstanding, as well as your asset base. And it's based on those 2 things that you have to file the report and you have to pay a fee. I want to say that the minimum is $400 or something like that. But in any case, you do need to go online and do your annual report, regardless of whether you have revenue or not. And then finally, we have a question about, do we have a recommendation as to what flags could be when taking money from private investors or VCs at such an early stage? Oh my goodness. Yes. So yeah, this is, I apologize, but this is way beyond kind of what we're going to get into here. I also encourage you to, whoever asked this or anyone who's interested in this, we have other presentations that we've done in the past that talk about fundraising. And as part of that, there will definitely be some areas of kind of gotchas or things to watch out for when we're fundraising to make sure that that we're doing the right things. So we encourage you to do that. I think that's kind of beyond the scope of and as well as the time on this presentation.
Awesome. Well, thank you so much, Sirk and Ala. And again, if anyone does have any additional questions, you can reach us at contact@earlygrowth.com. And if you want more information about what we do, especially on taxes, since this is tax season, you can find us on earlygrowthfinancialservices.com, and you can follow us on all social media platforms at earlygrowthfs. Thanks again for logging in, and we hope to see you for our next webinar, which will be on taxes later this month. Thank you so much.
Thank you, everyone.
Thank you.